I'd like to hear your views on what kind of options you're being able to present to your clients, and how does that, sort of play out for the customers here.
Thank you, Sanjay, and I would like to thank MCX for giving me this opportunity to be here today. Energy derivatives, they definitely are a very critical and important part of, I would say, any nation. If you look at India, for example, just to give some data points, if you look at India, for example, we are almost 25% of our gross imports is energy, that is crude oil. If you look at in terms of dollar terms, we are almost importing 130 this year, this financial year, we almost imported almost $132 billion worth of crude oil compared to $157 billion last year. So the point here is that energy plays a very important role in the life of each and every one. But the big question is, how do you actually hedge your risk? How do you actually manage your risk using commodity derivatives or energy derivatives for that matter? And the other thing is that if you look at the equities market per se, they have a very close linkage with the energy derivatives, because we see the way earlier the panelists were talking about crude oil prices spiking up towards 90, so whether it's going to sustain above that level. So that also has an impact on the overall equities markets. Now, just to give an interesting aspect there, comparing it with the equities, what we see is that if you look at, just talk about Nifty 50, so you'll find that among its breakup that you have across different sectors, so you have 33% of the total value of Nifty is more or less the financials, and then you have IT is around 13%, energy is around 13%, and then you have auto and FMCG, they are around 18%. So in Nifty itself, energy basket is around 13%. So that if anyone is looking at Nifty per se, so if you're understanding energy derivatives, you have an edge over others.
Amar, I mean, I sort of appreciate how you sort of try to bring that fact about energy derivative back into saying that everything will go back into energy, right? Energy is going to be an area which is enormously going to influence that, both base metals, as in basic materials, as well as energy is going to be the primary drivers of that growth. Insofar as to just talk a bit more about global best practices in that area, and maybe even just talk about some of the things that you think are needed in terms of size of contracts, things like that, which you think would be useful for energy derivatives, and why you think that from a trading perspective and from an investing perspective, why it leads to that diversification, if any.
As a firm, Optiver, who trades on 75 exchanges, we definitely see commodities playing a part of that. We trade SGX, CME, LME, and well, hopefully soon MCX, given the way volumes are going. What we are seeing is a demand for more accurate hedging, for a greater number of expiries, to optimize contracts for retailers. Over the last decade or so, we've also seen the financialization of commodities. And I think Amar gave a very good statistic on the percentage of airline industries that's allocated to crude oil. And in terms of global best practices, I think one thing that global exchanges are trying to do is to centralize liquidity onto an exchange. In other parts of the world, there's been rule changes like UMR rule changes, which are uncleared margin rules, which discourage OTC and block trading and try to move volumes to exchanges. And on that front, India is ahead. We've got 100% volume being traded on exchange. So I think we play a part in a healthy ecosystem of retailers, institutions, many of which are out there, fund managers, and as well as these HFT market making firms.
Coming to you, Vikram, I mean, like I said, you run a product which I enormously admire, and I find that it's a very valuable tool for both diversification as well as investing. And I know that you also have a fund which invests in energy. So maybe if you can start off by that and go from there.
So anywhere in the world you go, whether it is Europe or Japan or US, the energy markets are one of the foundations of those economies. So I think what I'm trying to say is that maybe the energy markets in India don't get the mind share and the mind space that they deserve. I mean, MCX is doing a fantastic job of creating an ecosystem, and we at mutual funds also try to give investors some sort of a opportunity to invest. I mean, we have a multi-asset fund where we do invest in commodities, directly into commodities, and energy is one of them. MCX energy contracts are one of them that we invest into. Just see how the diversification into commodity helps. So YTD, if you see the benchmark, you talk about Nifty Bs. The benchmark Nifty index is giving you about 3 to 4%, but the MCX commodity basket is up by 13 to 15%. Obviously, you'll say, look at 5 years or 4 years. I'll tell you how it helps you in your diversification. If you had a diversifier, if you were completely invested into equities, you would have still got 3%, 4% plus. But if you had some part of your portfolio in energy or commodities, you would have got a blended return which is slightly higher. How it helps in the long run is because if you have a portfolio which is an all-weather portfolio which gives you positive returns irrespective of what a particular asset class is doing, then you get better compounding. Diversification ensures that you have certain compounding. There's no point having a portfolio which is up by 40% 1 year, down by 20% next year. You will not even know that by the time you retire, you will be sitting, or by the time you need your money, you'll be sitting on losses or profits. So, as they say, don't put all your eggs in one basket. Look at commodities also for diversification.
And in that context, just like Vikram just spoke, that the diversification allows you to have a net positive effect on your portfolio more often than not. I mean, there can still be years that you could still lose money, but in effect, you've sort of you've created some shock absorbers for yourself. So I'd like Amar, I'd like your views on the same. About diversification from this point. I mean, what do you see with this larger retail customer base that you do have? Do you see this sort of theory or this sort of thinking start to come in?
Yeah, I would say that what we definitely see is that energy, because if you look at commodity space, primarily it's a bullion because people understand gold quite well, or at least they have that emotional connect with gold. The second is crude oil. So crude oil also is something which touches everyone's life very closely, and so that both from a I would say investing perspective or a trading or hedging perspective, it all depends upon the individual. So generally what we've observed is that those who have some understanding on the fundamental side as to crude oil, the way crude oil energy plays a role in the overall economy, they look at hedging their crude requirements on the exchange, those who are on the physical side. Those who are not, I would say, active on the physical side, and they are looking at commodity derivatives more from a hedging perspective or maybe from a portfolio diversification perspective. So there are challenges for the retail, because for that they require a significant size of the portfolio to hedge. But with the coming of the mini contracts in crude oil and natural gas, so that gives the retailers a chance to understand, because so having a blended mix of the asset classes definitely helps.
How do you view, zero DT options, daily expiry options, on anything first, and then specifically on energy? Does it really provide a mechanism for actually hedging your portfolio?
I think zero DT options do have a place as part of a portfolio. It does provide hedging benefits. I mean, let's give an example. You've got your equity portfolio, you've got a global diversified portfolio, but we're coming into increased tensions in the Middle East, or the Russia-Ukraine war is stepping another level, and you want to be hedging hedging the outcome of this peace negotiation. And that's where you can use very short-dated options to hedge your overall portfolio through a turbulent time.
Let's talk a bit more about, let's say, a nat gas, right? Now, it's an important contract, right? Most people seem to think that it's only a speculative contract. But the reality is that we import a fair bit of nat gas, and we do have domestic production of nat gas. So a reasonably good tradable benchmark price is extremely important for India. And also, it does provide somebody who's a fund manager, for example, the ability to trade multiple assets, right? So if you wanted to trade only gold, then you'd be just stuck with gold, right? I mean, so I just wanted your views before I open it up to the audience for any questions they may have.
Yeah, so talking about natural gas, natural gas, those who are into the commodity space, they really understand what volatility means and what natural gas means, the sort of volatility and price movement that we see. But at the same time, many times you really get very good opportunities, both from a hedging perspective and also from a diversification perspective. Because in commodities, what we see is that we've got a lot of historical data, a lot of seasonality is also built in commodities. That's one very good aspect. If you look at, compare it with vis-a-vis with stocks. So in commodities, you have that seasonality aspect, historical data is available. So you get a lot of cycles and movements which can be identified in the commodities, and be it natural gas or be it for the crude oil to a certain extent. So there it becomes imperative for those who are active in this market, different sort of market participants, be it the fund managers or be it those who are interested in that commodity, that they need to understand the fundamentals and the basic return drivers for that particular specific commodity.
See, one of the things that we have observed in the past data, I mean, obviously you will be asking, somebody will be asking a question today, why invest into crude oil or nat gas? What we have seen, I'm not talking about the world, I'm talking about India specifically, because we are a net importer and we are an energy deficit country. What we have observed, and again it is very, very approximate figure, that the crude oil prices have a 60 to 70% correlation with bond yields and inflation in India over a very long period of time. So that is a rationale why you would want to have crude oil in your portfolio.